Good morning, learners. I again welcome to the next section of this particular subject. The topic name is capital market instruments. So, in this session, we will talk about the various types of instruments which are traded or which are particularly purchased or sold in the capital markets. So, before moving towards the instruments, let us have an overview of the particular capital market, and finally we will dive into the depth of this particular capital markets. So, actually capital market instruments are those instruments which are traded in the market. So, capital markets actually are crucial for economic development. We know that very well. How they develop the economy, they actually provides a platform where savings and investments are traded. That means savings are transformed into the investment through the instruments. So, from institutionals or individuals are channelized into productive investments. So, that means savings are transformed from savings to investment from individuals and institutions into the particular channel through the instruments. Or in simple words, we can say that capital markets connect suppliers of capital. That means those who have capitals like institutions, individuals that have access to the funds, and with those people, those who have the required capital, that means those are in the requirement of the capital, such as companies, government seeking to expansion and expanding their operations. For these purpose they may require the funds. For these purpose the capital markets are playing, or the instruments are playing a great deal. Okay. Now, there are several instruments which are traded in the particular market, and these instruments that operate within these markets like equity instruments, common stock and preferred stocks, debt instruments like bonds and debentures, hybrid instruments such as what we can say, such as convertible bonds, and others like derivatives or REITs. These are some types of instruments which we are actually talking about and which we will talk about in this particular session. So, throughout this session we will explore these instruments in detail and try to understand what are these instruments, how these instrument functions, and what are their advantages and disadvantages when an investor might consider choosing one over the another. So, in this session we will talk about these instruments and pros, cons, advantages, disadvantages of these particular instruments. So, firstly let us come to the equity instruments or the equity shares, commonly known as, it is also known as common stock. Okay. So, what are these equity instruments? As we know that the equity shares are the shares which are issued by the company. So, let us begin with equity instruments, starting with common stock. So, what are these common stocks or equity instruments? Actually, what usually happens, common stock is like a most basic and widely known form of equity. Okay. When individuals purchase common stocks or equity shares, they are buying ownership in the particular company. That means when you are going to buy the equity shares or common stock in a company, you are going to become a part owner of that particular company, and this ownership entities them to share of the company's asset and earnings. By purchasing these shares, what they are going to get? They are going to get the dividends from that particular company, that is a share of profits. So, one of the key rights that come with common stock is a voting right. That means shareholders who purchase this particular equities can vote in the important matters of the company, like selection of board of directors and significant policy decisions. So, they provided with the voting rights when you are going to purchase the equity shares or common stocks. Another potential benefits from this particular common stock is dividend. That is, dividends are the payments made to shareholders from the part of profits, or we can say when the company is going to earn the profits, they will get the dividend. Who will get? The shareholders. However, these are not guaranteed and depends upon the financial health of the company and dividend policy of the company also. That means whether the shareholder will get the dividends, it is totally dependent on the financial health of the company as well as dividend policy. A common share also has a residual claim on the company's asset. What does mean the residual claim when the company is, what does it mean? Let's see. This means that they are paid only after all debts and obligations are paid. Preferred stockholders, that is preferred shareholders, are also fulfilled in case of liquidation of company. So, if the company is going to liquidate, they will be the last people who will get their share invested in the company. Common stock can offer high return, especially in the company performs well and its stock price appreciates. That means if you are going to invest in this particular type of share, you can have the opportunity to get the more returns. But if you are seeking for the high returns, then it involves the high risk also, as the stock's value can fluctuate significantly, that is based on the market conditions. So, what is the feature? If you want to have the more return, you can invest in the common stock, but risks are also associated with that. Next one, a type of equity instrument is preferred stock. It is commonly known as preference share or preference stock. Okay. So, let us talk about the next equity type, that is preferred stock or preference stock. So, it is also a type of equity instruments as common stock, but it has some its own features. So, preferred stocks are also known as preference shares, and the person those who hold this are known as the preference shareholders. So, they are also the part owners of the company as equity shares are, but their shares typically come with different rights. That means they have the different right or preferential right as compared to the common stockholders. They have some differentiated rights and maybe some preferential rights also. So, most notably preferred stakeholders receive dividends. Again, they get the dividends from the company, but what is the preference? They get it before the common stockholders. That means preference shareholders will get the dividends prior to the common stockholders. These dividends are usually fixed and regular. That means dividends which are paid to the preference shareholders are of fixed nature. They are not of variable nature, and these are regular actually. And regular making preferred stock attractive and invested seeking a stable income. That means such type of shares holders or shares are in, that is good for those people who are seeking for the stable income. However, preferential shareholders typically do not have voting rights. That is what the difference is in the rights. They do not have the voting rights in the matters of the company, which means they cannot vote on the corporate matters. If the company want to decide something, they can't vote it over there. Okay. So, in the event of company's liquidation, that means when the company is going to be liquid or when it is going to be closed, preferred shareholders have a higher claim on the asset than common shareholders, but still rank below the shareholders. That means we can say that the stockholders, that is preference shareholders, is going to get the payments prior to the equity shareholders in case of liquidation of the companies. So, preferred stock is less risky than the common stock, okay, and provides a more predictable returns. However, it generally offers lower growth potential because the dividend or the content of dividend is fixed in the preference shares. So it generally offers lower growth potential because its value does not appreciate as much as the value of stockholders in the boom stage of the market. The second one is that is known as after equity debt instruments. So debt instruments may be corporate bonds and debentures. So moving toward the debt instruments, and let's talk about the what are corporate bonds, what are the debentures. So let's start firstly with the corporate bonds. Both are the debt instrument. Debt instruments mean that you are trying to provide your money as debt to the companies. So debentures are long term financial instruments. So these are actually the long term financial instruments issued by the companies to borrow money from investor who buy these shares or debentures. That means person though who are going to buy this particular debentures are going to provide their money and get it back with some interest. So investors who buy the debentures are essentially actually lending money to the company in exchange for a periodic interest payments and the return of principal at maturity. That means the persons those who are investing in the debentures, they will get the interest as well as the amount invested at the time of maturity. It is known as redemption. So unlike equity, debentures do not have the ownership rights. They are the contract obligations only. That means the debenture holders are not the owners of the particular company. Debentures often carry lower risk than the equity since bond holders or debenture holders paid before shareholders in case of bankruptcy. That means if the company is going to be bankrupt, then in the payment side, firstly the debenture holders are going to be paid, thereafter preference shares, and thereafter the equity share will get if left out, otherwise they will not get the shares back. However, the trade-off for lower risk is generally the lower returns also. So there's also the possibility of the issuer defaulting. It may be possible that the issuer of the particular debenture or bond may on the default. What is that default? They are not going to pay back the amount. There's so which introduce the credit risk. Additionally, market risk can also affect bond prices, contributing to the interest rate risk. So there are three types of risks which are associated: interest rate risk, default risk, and market risk. Okay. Debt instruments also covers the bonds that are issued by the government, which are commonly known as government bonds. Okay. So government bonds are actually another type of debt instrument which are typically issued by the government companies, by the national government to finance the expenditure of the public, like public expenditures on infrastructures, defense, and social programs, or whatsoever the company or the companies are meant for. So these bonds actually are considered with a low risk, especially in the stable economies, where the economies are stable and there is no violation or the volatility in the economies. For instance, talk about the US Treasury bonds are often called as risk-free investments because the US economy is very stable and the bonds issued by the government are actually carries a good return, and stable return leads to the low risk or zero risk because they are backed by the full faith and credit of the government. Okay. So investors receive regular interest payments and return of their original amount which is invested in the bonds at the maturity by investing in the bonds or what we can say debt instruments. Government bonds offer predictable, that means we can predict like how much type of return or how much return they are going to pay or how much income a person can earn by investing in such bonds, but generally provide lower returns as compared to the corporate bonds or equities. They can be an ideal choice for the conservative investors, those who do not want to take more risk and which are looking for the capital preservation and a minimum amount of return on their investments also. Even though they are safe, they are not risk free, but because interest rate risk can also affect the market value. Okay. So, we can say that they are very less risky, but they contain the element of the risk due to the change in the interest rates. Next one is hybrid instruments. So, these are the pure instruments which we discuss now, equity instruments and debt instruments. Hybrid instruments are something like that, we can say that they have the option of corporate bonds, convertible bonds. That means firstly we issued at bond, thereafter they can be converted to the equities. So, these are a set of concept in this convertible instruments or hybrid instruments. Now, let us talk about the hybrid instruments, particularly the convertible bonds. So, convertible bonds are actually the debt securities which can be converted into predetermined number of shares of the issuing company as common stock, as preferred stock, as well as other instruments of nature of equity. These bonds actually provide fixed interest payments like traditional bonds. That means hybrid bonds also provide the fixed interest rate as traditional bonds, offering stability and income. So, what does it offer? Both stability and income. However, they also come with some, what we can say, option to convert into equity. That means once you are issuing the bonds, they can be converted into equity. Such types of bonds are known as convertible or hybrid bonds, and which allows investor to benefit from an increase in the company's share price. That means first we purchased at bonds, bonds have the feature to be converted as equity. So, the investors can get benefit of the fluctuations in the share prices. So, this type of dual benefits makes them attractive to the investors, those who want to or those investors who have the objective of the stable income as well as the appreciation in the capital also. So, these are the instrument for those investors. Now, on the downside, the convertible bonds typically offer lower yields, as we know that the bonds usually offer lower yields as compared to the equities, but such type of convertible bonds also provides very lower yields, and if converted they dilute the ownership of existing shareholders. Okay, that means they will dilute the ownership of the shareholders which are existing in the company. Thereafter, the next instrument which is usually known as derivatives. As the name itself says that derivatives are complex financial instruments whose value is actually derived from an underlying asset such as commodity, stock, bond, or the currencies also. That means derivatives can have the value from these instruments. On the basis of these instruments price, a price can be quoted for the coming future. So, common types of derivatives actually includes futures, options, option of the two options, that is call option and put options, and swaps also. So, these contracts can be used for hedging risk. That means these contracts, option, future, swaps can be used for the purpose of reducing or hedging the risk as well as speculative purposes. Let us have an example to understand the concept. An investor can use options to hedge against the risk that is associated with the stock price decline. Okay. So, they can use this particular type of derivative to a decline in the stock price. While actually derivatives offers the potential for significant profits and risk also associated. So, management they also carry high risk as well as high returns. That is what about the derivative instruments. Okay. So, next coming to the next topics also, but let us have a one point of on this particular complex derivative instrument. They are actually complex to understand, and because of their leverage, small market movements can lead to large gains or losses also. Okay. So, it is about the derivative. Investors need to thoroughly go through the instruments firstly, go through the markets, understand the derivatives, how these derivatives work before investing in such type of derivative instruments. Investors' knowledge about the instrument, such instruments is required, then only they should go for the such type of instruments. Last one is the real estate investment trusts. Now it is an innovation type of product, that is real estate investment trusts are there. So such type of innovative products are actually related with the, we can say, real estate companies or such trusts or companies that are own, operate or finance income generating from the real estate sector. Okay. These instruments actually what they used to do, they invest the funds accumulated from the public and invest in the companies which have the real estate. So, they allow individuals to invest in large scale diversified portfolio and real estate assets in the same way they invest in the other industries through the purchase of stocks. Okay. So, these are some basic instruments of the capital market in which investors can invest. So, but one more thing is particular about this REIT trust, that is REITs must distribute at least 90% of their taxable income to the shareholders as dividend and making them a popular choice for income focused investors. Okay. That is the main reason why such type of REITs are famous. They offer high liquidity as they are traded on major stock exchanges, unlike the real estate investments. So, I think that is all about the instruments which we talked in this particular session of the capital markets. So, thank you for the session. See you in the next section. Thank you.